Yeah, you and me both. Todd says, love scalping Gamma for winning trades. Just need more out of the monies to go in the money. So you want to scalp Gamma when it's in the money. But I always do this kind of example when we're teaching how to manage options with stock. I think that fit earnings trade is really a great example. But this is just, ABC stock trading at 13. 13s, I just made some silly values. I just made them up. But we can kind of back into it. What are the 12s worth here? So if the stock's at 13, what do we think these 12 calls are worth? There's no bad answers. $12 calls? Okay. There we go. 12 calls. The stock's at 13. There's going to be $1 of intrinsic, right? There's $1 of stock. And we know how much premium is in this thing because we can look at the puts. $1.70. $1.50. $1.30. $1.10. Oh, I'm duh. $2.50. $2.30. 3. $4. And then $5.05. Isn't that cool? Cool, right? So we can always know what the calls are. Yeah, and always know, and the same. So think about it. These are going to be $1.70 because the stock's at 13. 13 minus 12 is $1. And then we can just look at the premium, the fluff, the nonsense, right? This isn't real. There's no real stock in there. So we can do the same thing with the puts. 14 strikes going to be $1.70. Yeah. Then we got 240. 320. 405. And then call these $5. Okay? So just simplify. If you start thinking like that, I think it really, really simplifies things. Okay, and these are going to be the at the money. Give them a little border around for the at the money. Same thing with delta. Delta, we could just look at, if there's no premium in them, the delta of this guy's going to be 1. The delta of this guy's going to be 1. The delta of the at the money is always 50. Okay? Todd, that's correct. That's correct. So I made the downside puts a little bit more expensive than the upside calls because of skew. So these 10 puts are 30 cents. 3 higher is going to be 20 cents. Because skew is the market is going to make the downside stuff a little bit more expensive than the upside. Why do they do that? They do that because if we want to protect ourselves, we're going to buy calls. If we want to do covered call strategies, we're going to sell upside calls. I'm sorry, if we want to protect ourselves, we're going to buy puts, downside puts. So it's going to make them a little bit more expensive. The other popular trade that people like to do is selling upside calls. So that's why market makers make the upside a little bit cheaper and they make the downside more expensive because they know that's what we want to do, right? Common sense. That's how I would price options. If everybody wants to buy the downside, I got to make them a little bit more expensive or else I'm going to be short a lot of downside stuff as a market maker, and I don't want that. Hey, Mike Kelly, did you, you might want to buy stock on your FIT, by the way. I don't know if you did. Awesome. Good. Good. And it's the same thing, right? If FIT opens at 10.50 tomorrow, we'll be kicking ourselves that we left that money on the table, right? That's $1.50. That's a lot. Okay, so let's talk about managing our options position. And let's use the, so I just put options positions in the calls and our options positions in the put. So let's just say that we're long a 10 lot on the 14 strike. And let's ignore, the prices don't really matter. So right now with the stock at 13, I'm going to look at this as the equivalent of being long 1,000 shares. What happened to my green? Okay. So I'm going to look at this as being long 1,000 shares. So right now, if I'm long 1,000 shares from 14 and the stock expires at 13, these are worthless. They're dead. They have no value whatsoever, right? Because we're long from 14. But if this stock rallies from 13 and goes up to 15, now we're long 1,000 shares from 14. So if we wanted to, say we're bearish on the overall market, we could always sell 300 shares. We could sell 500 shares. We could sell 1,000 shares. We can't sell more than 1,000 shares or else we're taking an outright short position. Okay, so we'd be long 1,000 or 10 calls. We could sell 300. And that's going to give us a net of 700 longs, or this will be down to 7. If it keeps rallying, we could sell 300 more shares. Long 1,000, short 300, short 300. We still have a net long exposure of 600 shares. Confused? Everyone with me? Good. If anybody's not, I'm happy to go over it. Awesome. Okay, so when I do this, I usually do it like in thirds. It's just force of habit. There's no real reason of why I did that. It's just, I like to get on prints is what I call it, like this Fitbit. It goes down to 9. I want to make sure that I get trades at that level, because if it goes to 10.50 and I don't, I'm going to be really upset. So I'm always going to make sure that I get on prints. Because what's happening here is by doing this, I'm locking in profit, but I'm also drastically reducing risk. Because even though I'm not touching the calls, I still own these 10 calls. But in actuality, my position is long 6. Now, I don't want to change that because I don't want to mess it up. I don't want to mess you up and think that I'm covering my calls because I'm not touching these. But what's really going on is I'm long 6. And I've locked in $300 on this trade. And I've locked in $600 on this trade. So if I bought 10 for $700, right now I made $1 here. I made $2 here. So net, I'm long 6 calls and I'm up $200. So I've taken all the risk off the table. Worst case scenario right now on this position is I make $200. And that's why we do it. That's options trading. Mike, yeah, I have a lot of YRCW. I'm just going to be patient. I mean, it's just not working out right now, but yeah, I buy YRCW. It's like a bad habit right now. I just don't get too crazy. I mean, I have my limits, but I'm going to get, I don't think it's just going straight down. I've traded this stock for a long time, 16 days, election, there's a lot of stuff left in the market. Okay, so this example, we go from 14, 15, 16, we sell, sell, sell. And now, if we take this off and the stock gets hit, and it goes down there, we can buy our 600 shares back. Okay? Short, short. Went back down, we could just buy those back. We're still long 10 calls. Right back to our original position. So by doing this, and that's why I say volatility is so important when you're trading options. Like, you need to trade volatility. You really need to have a nice firm understanding of volatility. It's because of this. Because somebody who just buys these 10 calls, and if ABC goes from 12 to 15, down to 12, up to 15, somebody who doesn't know how to trade options is thinking, wow, this trade's terrible. I can't get in the money. I'm losing money. But we're going to be sitting here trading this thing back and forth, ripping money out of the market. It's a much stronger hand for us to hold and to have the flexibility to do this kind of trading. Okay, so we understand why we bought those 600 back when it went offered. Because these, think about it, we're no longer long 1,000 shares because we're no longer in the money on this 14 strike call. So as it goes down, we're not in the money. We're just naked short. We're just short ABC. I don't think we want to be short ABC, so let's buy those shares back. And then we're continuing to lock in profit. Right? That would be short 600 from 1550 average. Right, so what's that? So now we're up $1,950 doing this. I love it. It seems like everyone's okay on this. Just watch out. Just make sure that when you do it, once your stocks are in the money, if you have a spread, so if we're long 10, let's say we're long 10 here and we're short 10 and we're in a spread. Here we don't want to scalp gamma because we're long 100 shares from 12 and we're short 100 shares from 14. So we don't want to scalp gamma because we're already long and short. Okay, if I pull up an options grid, and we look at, I don't know, let's look at Microsoft. And let's say stock's at 59.43 and we're long these 60s. The other way we can get out of this is we can obviously just cover these 60s if we're long. 60s are here. but we could also roll it into a spread. And I guess let's look at that EWW because that's a better example, because this is for those who aren't members, these are positions that we have in the Premier membership. And we are long these November 9 47s. Call them $1.30. But we're in from like 85 cents or 90 cents. So right now, these are not in the money. But if we're long from 90 cents, and if you're long 10 of them, I sent that a Premier member alert today, let's try to sell 10 of the downside puts. So if we're long 10 from 47, and say we're long from 90 cents, and then say these 44s we could sell for 50 cents. So we buy them for 90 cents, we sell them for 50 cents. If we buy 10 of them, that's $900. If we sell the 44s for 50 cents, that's a $500 credit. So now we just have a net debit in our spread of $400 or 40 cents. And that would be the 47.44. And this is how I'd manage this trade because it's not yet in the money. If we're long the 47 puts and short the 44 puts, we can never lose more than we bet, so we can never lose more than 40 cents. And the most that we can make is always going to be the difference between the strikes. So if we pay 40 cents for the 47.44 put spread, buying 47s, selling 44s, the most that we can make would be $3, 3,000, minus whatever we paid. So if we're in it for 40 cents, 3,000 less $400, our reward is $2,600, and our risk is down to $400. And that's what I'm always looking to do when I trade. That's a big reason why I don't really sell options very much. I don't get net short options. I do sell options on occasion, but I don't want tail risk. I don't want to risk $2,000 to make $500. I want to risk $500 to make $2,000. And I want to get really, really good at that because it's just a better way to live. In my opinion, at least. So that's how we're looking at that position. I'm always looking, if we're not in the money, always look to roll it into a spread if you're looking to limit your risk. Todd, I think that's fair to say. So Todd says it seems if you're with long out of the money options, the only managing to be done is when it moves in your favor. That's fair. When it moves against you, that's correct. There's not much. There's not much you can do. So those are the three ways you can manage it. EWW. You can just get out of the trade. If you're in the 47s from 90 cents, you could get out at $1.25 or $1.30 and just lock it in. I like selling these downside because it keeps us in position while still lowering our risk. The other option would be to scalp Gamma, but it's not in the money, so I really wouldn't want to scalp Gamma. And if you guys could see that, if we're long the 47 puts, and if we buy stock right now at 48.65, if it goes to 47.50, we're going to lose on both sides. Right? So it just doesn't make sense. Now, yeah, if it rallies up, great, we bought some stock, but I would rather do the put spread. So talking more on a position basis, I really always want to get a nice balance between calls and puts. And my thinking is if I buy options well, which I'm confident that I know how to do, and if I have a nice balance between calls and puts, when I'm right, which for me, I don't really need the VIX to go up to be right. I think if the VIX just stays the same, I can be right because I'm buying them well. I can make money just upon, because I don't care which way it goes, whether it goes higher or goes lower. These times where volatility goes higher, that's just a bonus because then we're getting the movement, but we're also getting the additional premium in all of our options across the board. Todd, did you have a question today on the board, I believe, about finding some downside exposure? Yeah. Okay. So, Todd had a good question talking about if you wanted to, if you think the VIX is going higher, if you think the market's going lower, what's a good way to express that view? And I hate products like UVIXY and any kind of VIX-related product. I just don't really like. I don't like trading leverage products. But what I do is across all my holdings, any place where you're short options, the first thing you can do is you can buy those back. You want to make your portfolio long volatility. So if you're short options and you think volatility is going higher, don't be short options. And then you could buy really any downside puts, because if the market gets hit and volatility goes higher, for one, the puts are going to go up in value a ton, even if that stock doesn't move. But most of all these companies are going to have a beta of 1. I mean, I'm looking at the stocks that I look at throughout the day, and everything's red today. The only thing that's not is our energy, some of the energy names. All of our energy names, actually. I know gold was pretty strong earlier. You know, things like that move against the economy. Yeah, defense stocks, those are going to be strong. But otherwise, I would just take the stocks that you like to trade and buy some downside puts. Buy some straddles. Mike's asking if I think the VIX will stay at these levels until the election. I think so. Let me just. So if we look at the VIX, so the VIX is elevated. I think rightfully so. I think the VIX is going to be strong going into unemployment, but then I think after unemployment, it's going to go down. After that, yeah, there's going to be risk going into the election. I don't think I don't think the market's going to get killed. I really don't. It makes me really angry when I see all these emails from all the the guru circuit talking about how the market's going to crash, and they're just doing that to scare people. They have no idea. I think the election's going to be a lot more muted than people think. I was looking at odds for the U.S. presidential election, and the odds right now are like 2.5 to 1 for Trump to win. I think that if Trump wins, volatility is going to go insane, but I don't think that's really a high probability. So I think that if things just go along as I expect them to do, I would think that volatility hangs around here. There'll be a little bit, but I wouldn't be surprised if next week, if it just kind of leaks lower. I think we'll have some sharp moves back and forth, but I think it's okay to trade from both sides. The only concern I would have with the VIX going higher is nonsense going into the election as far as it being, not conceding victory and stuff like that, which, for all of our sake, I don't think it's good for anybody if any of that happens. So that's my thought. I think that if things happen as the odds are pricing them, then I think that things will be fairly muted. I think that if there's a big surprise come election time and Trump does win, then I think that I think the market will go down 10%. I just don't think it's got a high likelihood of happening. Don't markets generally tend to get shaken up at the end of a two-term president, especially if there's a change in party? Yeah, sure. I mean, Trump's just not a politician. Who knows what he's going to do? I just don't think that there's a high likelihood chance of him winning. David's asking if I think the market's going to drop, what put options would I buy? If I think it's all, so options are all going to be timing. So if I think, and I don't, by the way, I don't think the market's going to crash. I don't think the market's going to go down. I think right now they're just kind of testing the downside to see what's out there. But I do think it's going to stabilize. If the market really starts to get hit, you can buy any puts. It just doesn't matter. It really doesn't. I wouldn't overthink it. It's like I was bearish the other day. I sent out that Premier member alert just saying, guys, caution flag, just protect the downside. And all I did to protect my downside was I bought more of a stock that I already liked. I bought more puts in a stock that I'm already long a straddle because everything is going to get dragged down. And, that's working out great. Market's going down, but there's not a direct correlation. I just think that once things start going down, everything has a beta of 1. And rather than overthink it, what I would suggest is go to the spreadsheet. Look where we're looking to buy options and buy those options because those options, I've already done the work. I already know those options are inexpensive. I don't need to then go and look what happens if the VIX goes to 30. Where would I go? Well, right now I'd like to buy some EWW. I'd like to buy some of these oil stocks, these Permian Basin stocks that are all over the place. So that's how I really use the spreadsheet like that. I do the work all beforehand. Wow, Facebook, 117. Wow. I thought their earnings were fine. That's a buy. That's ridiculous. Wow, see, that's a perfect example of the call going on right now, and Facebook didn't react very much after earnings, but then whatever he said on the call just knocked it down. Will I have less positions going into the election? No, because my positions are long vol. I'm naturally long volatility. So I like having risk going into the election. I want movement. I mean, as a trader, I want craziness. I like that. I especially because I like to buy volatility. I'm really good at buying options. That's when I'm going to really, really crush it. The longer we stay volatile, the better I'm going to do. And I think that's because I can value things quicker. I think that I can trade reactionary. Even today, now that volatility is going higher, all day I have so many different trade ideas. I have to stop myself from sending out alerts nonstop because there's a lot of people that I send out emails to, and I don't want to just keep churning ideas out there because they might be difficult or overwhelming for people. And that's why the Netflix idea I just decided to share on the board, because at least I know that the people in those rooms, have taken some of my work and understand things a little bit better than the overall community. But when volatility is higher, that's when I'm going to really go after it. Hey, Rick. So good question, Rick. Rick says a position concerning A question concerning position sizing. Do I have a target risk level for each trade, such as 1 or 2% of total account? I look at risk more from what I'm willing to lose rather than from the value of the account. I don't like having too much of a position in one type of product. Excuse me, I'm just hiccuping. Like, I don't like having 70% of my risk in long volatility and options. Like, that's not okay with me. So if I have in my overall portfolio, let's say if I'm 30% in options, well, then I'm going to want to be, half and half as far as calls and puts. If I'm long a bunch of calls and puts, I'm going to want to be short a bunch of other stuff. So if the market goes higher tomorrow, I want to make sure that I'm going to get paid on having some covered calls. I think if the market goes higher, covered calls are such a good position right now because the VIX is higher. And if the VIX is higher and the VIX goes lower, all that premium is going to be sucked out of options and the whole market's going to go higher. So I'm okay on the downside. I'm always going to be okay when the VIX goes higher. My risk that I try to protect is if the VIX goes to 13 tomorrow and the market goes up, 80 or 90 points. How do I look then? And that's why today I'm taking off positions. GDXJ clear. It's working out really well. I still like it, but I have enough risk on other places where I want to lock in money and take off risk. Okay? So long clear, long GDX puts. I wouldn't cover that position if that was my only long options, because then I'd be covering all my long exposure. Then I would no longer be long the VIX. I have other long options, so it's easier for me to cover those long options. So Rick, to answer your question, I know this is kind of circling around a little bit. More, I want to stay balanced, meaning that if I'm going to have daily swings of $10,000 in options, I don't want daily swings of $500 in futures. Okay, then it's just a waste of time for me because it's not going to be balanced enough to offset my options. So then I'm going to have to say, if I like that futures trade as much as I like those options trades, well, I got to get my risk up in futures to balance it out a little bit. Because I look at it, I really try my best to look at every trade as just a good opportunity. And so I don't look at trades and say, this one's a 10, this one's a 9, this one's a 7, this one I really don't like very much. Well, if I don't like it, I'm going to get out. I want to look at it like a casino, where every hand it's the same. I'm just trying to make a lot of little bets once in a while. They'll hit it big. I want to cover my risk. I don't want any tail risk. And I just want to consistently be able to take money out of the market. But I want those, when I'm managing my portfolio, I want them to balance out somewhat. So if I'm risking, 10,500, well, then I'd probably need to risk 3,000 in the futures and then bring my options risk down. So the options aren't just overwhelming my portfolio. Yeah, my pleasure. Todd's asking, what percentage of my account will I put at risk from a buying power or from a literal standpoint? Because I don't look at risk from buying power. I look at risk from, if I'm long 10 calls for $1, I have $1,000 of risk. Oh, from literal? I don't know. Not more than 10%. Not more than 8%. Not less than you think. I don't want to have a losing month. I don't want to be in a situation where I lose something and it's going to take me 2 weeks to get back. okay, that I've done before. It's really, really, it wrecks your confidence. It really destroys your confidence. So I look at it as if I'm going to lose, I want to be able to make it back in, 5 days or 3 days. I don't want to take these wild swings because then I just feel like I'm always chasing. And that's really not a good way to live. And I think that's from being in a hedge fund environment as well, where you only get paid if you're taking out your highs. So you always want to just, so for instance, the way I manage money, if I'm managing $100 and I make it's 102, 104, or 105, and then I pull back to 99 or 98, I'm absolute tunnel vision to get back to 105. I don't really care about anything else. I don't care about making a ton of money. I just want to get back on track. And then when I'm doing well, I look at my own performance just like I would a trade or any other stock. And when it's stable and performing well, I'll get more aggressive. But when volatility comes into my P&L, I know I have to pull back my risk because I don't want that. I want to be able to control my risk. And so when things are going well, I'll be very aggressive. But as soon as things turn or if I go through a bad time, I'm going to get really, really conservative and I'm just going to grind. I'm just going to go back to consistency. I mean, I do stupid things too where I'll go back and make myself run 3 miles every day just to get just exercise and discipline that I'll force myself to do. I know how I work, and I know that when I was younger, I gambled a lot, and I gambled not only in gambling, but it would come out in trading as well. And I know that if I don't control that, then I don't trust myself just playing the game. And I don't mean like gambling like I had a gambling problem literally, but I do mean that if I let gambling get into my trading, or if I'm in that previous example, 105 and I drop down to 95, and then I think about trying to get back to 105 in one trade, that doesn't work. It's just a slippery slope that I've been on, and I really, really try my best to avoid that as much as I can. And that's also why I don't like selling naked options, even if they're high probability trades, because those can dig holes that it's just not fun to pull out of. Then I'm in a bad mood for a month, and it's, then everybody in my life can feel it, and I can feel it, and it's bad energy, and I'm trading bad, and I don't have the patience that I normally do, or I have too much patience. So I think that's just just managing a lot of traders too. I think that's very it's very personal. Like you have to know what your strengths are and what your weaknesses are. And I think a lot of the strengths that I've seen from members is those who can paper trade longer, those who can, just through questions or asking good questions, it's a good approach. Paper trade as long as you can, because it's easy to make money 3 months down the line if you really, really take your time and you're nice and disciplined. But it's not easy to pull yourself out of a hole 3 months down the line once you learn more and get more comfortable. It's like the perfect example, guys, is this fit trade. Think about the fit trade. It goes down to 9, and then you walk in and it's at 11, and you leave that money on the table, and you just leave that money on the table because you didn't know. Like, that's hard. Those are things that we need to know, especially if we're if we're trading something like fit. I know some people just put a one lot on. It's $140. It doesn't seem like a lot of money, but you still have to be there to lock it in, because if you can lock it in, that's a $350 winner, and that puts you on the right path. But if you put yourself in a situation where you need to make money, the market will take advantage of you. So my smaller account or bigger account, it doesn't matter. There's no difference between 10,000 and 100,000. I mean, obviously there's difference as far as buying power and things, but you know, the $100,000 guy, you know, he's earned that right to trade a little bit bigger. It's the same way. It's easier for me to trade than a lot of other people because I've been through these experiences, and I have a bigger account, which just makes things easier. But trading's weird because learning with the smaller account, that's the most difficult it's ever going to be. So you have to make sure that you're as prepared as almost you're ever going to be to trade that, because it's you know, trading a $5,000 account, it's hard. It's really hard. I was on a webinar. I was presenting after somebody who said, right before I got on, he said to the audience, he said, if you're not making 5% a week, then you're failing. You're doing really bad. Like, what are you talking about? 5% a week? I've never even heard something just so silly and dangerous and unfair. It's just like, I don't know, I feel like this whole industry just has retail traders just so far out of perspective. 5% every month is better than any hedge fund manager in the world. So Ben, great question. So Ben says, referring back to scalping Gamma, how does that technique tie into actual Gamma? Well, it is Gamma. I'm trying to think of how to explain this. So all Gamma is, instead of thinking about Gamma, is it fair to say that everybody understands theta? Theta is just time, right? Time coming out of options. Straightforward. Okay? So theta on this Facebook now, so right now, theta at these 127s is 17 cents. So 17 cents are going to come out of these options every day. Okay? Right? I think we get that, right? Theta, theta, theta. All Gamma is the exact opposite of theta. That's it. That will help you understand Gamma. Theta and Gamma, if you take the opposite of theta, if you take the opposite of Gamma, you get theta. They're the exact same things, they're just opposites. So this is the power of Gamma and why Gamma matters so much. Okay, so let's take that off. Let's take this off. Okay. ABC stocks at 13. Okay, ABC stocks is at 12. We're long 10 of the 12 calls. Let's say these are all 0. We don't even need this. Okay. We're long 10 calls at 12, right? So here's Gamma. Let's think there's 5 minutes to go until expiration. So this is Friday afternoon of expiration. And ABC stock is trading at 12:05. So if it's trading at 12:05, we're long 1,000 shares, right? We're long 1,000 shares, but there's only 5 minutes to close. So what I would do is I would sell 1,000 shares at 12:05. So if I sold 1,000 shares, I'm locking in a nickel, okay, because I'm long from 12, short from 12.05, okay? Now let's say the stock drops to 11.95. Well, now these are worthless. My gamma just went from long 1,000 to short to 0, actually, because now I'm just short 1,000 shares. So I got to buy 1,000 shares back. And now if this goes up to 12.05, what do I have to do? I got to sell 1,000 shares. And this is gamma. That's all gamma. Okay? The fact that it's moving with 1 minute to go before expiration, like this, is all, it's the reason it's doing that is because gamma. Okay? Stock at 11.95, the delta is going to be 0. At 12.05, the delta is going to be 1. Did that make sense? I feel like this one could be could be a little confusing, but if you do it on paper, if you're long the 12s, just look at expiration if it's at 12.01 or 11.99. You're either long 1,000 or you're flat. Long 1,000 or you're flat. That's gamma. That's gamma. Oh, Todd, my pleasure, man. Thank you for writing that. So Lise, you can, no, because you don't even want to start thinking like that. Lise is saying, can we manage these positions by just buying the puts? And the options market is not liquid enough to do that. So I don't even want to start going down the path of maybe you could do that because it's just not a good way of thinking. Okay? You don't want to manage your positions going with puts because you're going to pay the offer and you're not going to get good fills, and usually there's not liquidity to do that. So you don't want to do that. But what I really want to show with this example is just at expiration, the worst thing that we could have, oh, my pleasure, the worst thing that we could have is the stock closes at 12. Right? If the stock closes at $12, expires at 12, and we're long 10, that's called pin risk, and that stinks. Because then we don't even know if we're long 1,000 shares or if we're not long 1,000 shares. So that's why if anything's by our strike at expiration and we're long, just get out. You just want to cover your options. Because we don't want pin risk. It's kind of weird that the options market closes on Friday where we can't trade any more options. But did you guys know that the options market really closes at 10 a.m. Eastern time on Saturday? So if the stock closes at 12 and we're long these 10s and we don't know if we're in the money or not in the money, there could be some horrible news and send the stock to 8, or good news and send it to 14. Mitch, nice. Okay. Maybe some people did know that. That's great. But that's why we don't want to deal with any pin risk. So just cover, just get out. It doesn't matter what the gamma is. It doesn't really matter what the number is. You don't have to follow the Greek. Just follow it from, you're long 1,000 shares from 12. Just like you would follow it like if you're long stock. Yeah. And just think about what you invested in the position, and I would start scalping gamma at a place that you're making money. And I like to do it in thirds. And just be patient. Sell 300. Wait. Sell some more. Like give it room. It's okay to make a bunch of money on trades, but you do want to get on prints. You do want to make sure that when your P&L is showing a really good number that you haven't seen before, you want to be able to lock some of that in. We don't want to just stare at good numbers and then have it all be paper profits, because that's not real. Mike, FIT is trading under 9. You just made 200% on that position. The best. Mike hadn't looked. He just found out he makes 200% on that. Yeah, Mike, you destroyed it with that thing. Look, here it is. Free falling, trading 902. Nice. Nice trade. Awesome. All right, guys. I think we'll kind of wrap it up there. We covered a bunch. I'm going to stop recording now.